So until now, we've studied three tools that the Dow theory for the 21st century has to determine buy and sell signals. The normal one, secondary reaction, pullback, high, then breakdown. Then a second one, alternative one, which is the breakdown or break up of the lows highs of the last completed secondary reaction. Thirdly, we also examined the bull and bear market definition, which is also an alternative way to derive buy and sell signals. And now, last but not least, we are going to examine capitulation. Capitulation is really very important because Rhea, in his book The Dow Theory, said that occasionally it makes sense to bet for a mean reversion trade. So we are trend followers, that's good, but I would say that we are trend followers 95% of the time. But sometimes it pays off to bet on a mean reversion. Capitulation, as the name shows, bets on a reversion of the market. And it only works when the market is going down. So let's see, we have the S&P 500, it's going down, 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 and then there is an acceleration down. And the same happens to the Dow Industrials. And please note that I've written down NYSE because for capitulation, we want to see the whole market, the very broad market, also capitulating, going down, really accelerating. So capitulation is a proprietary indicator, but I can disclose as much as I disclose on my website, which is a lot. So any intelligent person putting a little bit of effort can really guess how it works. But I will give the basics. Capitulation uses a weekly moving average of the closing prices of each index. And what it explores, let's plot an imaginary moving average, and a moving average would be going something like this. If we plot a moving average, so capitulation measures the distance between our price and the moving average. So when this distance becomes too large, it means it's like an extended rubber band and it tends to snap back. Imagine this is the moving average, this is our price action, and it becomes more and more and more stretched. It means that the downward price action is really accelerating downwards, which is normal in conditions of capitulation. And once this rubber band, once the price deviates so much from its moving average, the most likely outcome is that the rubber band will snap back. So we take the weekly moving average of prices, then we measure the distance between the moving average and price action, and when either two of the three exceed a threshold, you can find more details of the capitulation indicator going to this link on our website to explore further. But the concept is very clear. Sometimes the market really goes down and accelerates its downfall, and when the rubber band becomes too stretched, then the conditions for capitulation are met. Once again, we require confirmation. You know that confirmation is really very important here. So we require that any one of the three indexes confirming, not necessarily the S&P 500 always, it can be the Dow Industrials and the NYSE, or the S&P 500 1SE, any combination, but we need at least two indexes confirming the capitulation conditions.